clearly, we all know this, silver has moved meaningfully more rapidly than has gold. But again, if you look at silver on an inflation-adjusted price, it's still well below, 50% below its 1980 and 2011 highs. You go back to 2011, the last major top, or 1980, the major top before that, you were getting massive flows into the gold funds. In 2011, GLD itself, the physical gold ETF, was trading at a premium, not just a one-day premium of 0.5%, but 4% premium for weeks on end. That shouldn't happen to a gold ETF. And the inflows were just massive. If I said to you that the GDX had net outflows for the past month, would you believe me? Most people are astonished when I tell them that. It's easy to verify. The GDX has net outflows for the last month and net outflows for the last 2 and 3 months.
You think that translated into higher share prices for the miners because that money went to the miners? Maybe that's what happened, or
There's some of that.
Yeah.
There's some of that. But the GDX is a vehicle that is used primarily by generalist and retail investors, not gold people like this. People at this show are already involved in the gold market, right? And it's wonderful to see the audience here, the participation so high, much higher than last year. But these are people who've already been involved in gold. I'm talking about the non-gold investor, the dentist in Oklahoma who's probably never owned a gold stock in his life, or the last time he owned it was 2011. Or the financial planner of Schwab, who has no allocation to gold.
The fact that the gold-silver ratio went down in a vertical line from 100 to 45 in a matter of weeks. What's your reaction to that?
You know, I'm not a huge follower of the gold-silver ratio, and I'm sorry if I offend anyone.
That's okay.
but you can look at it over the last 10, maybe 20 years. But I hear people looking at the gold-silver ratio in 1900. It's meaningless to compare it with where we are now, because the dynamics of the internal fundamentals of the silver market are just so dramatically different today than they were even 25 years ago. You look at the supply side of silver, where 25 years ago, 75 to 80% of silver was from primary silver mines. Today, the reverse is true. 3/4 of silver production is byproduct.
Yeah.
And it's mostly byproduct of base metal mines.
Right.
Gold at 5,000, silver above 100. But this is not the top. No retail mania GDX sees outflows. The new buyers are central banks and Tether buying for treasury and chaos, not economic signals. Mining stocks are historically cheap with cash flow soaring. Adrian Day's top picks are gold.
A gold fund, of course, a U.S. gold fund has to be fully invested at all times. So let's say what I'm doing with my separately managed accounts. You know, it's all very client specific, frankly. If I've got a conservative client who's 65 years old, 5 years ago he was 65 years old, when he opened the account and he had a 20% allocation to gold, I'm trimming that to get him back to 25 or 20%. No question. But if I've got an aggressive investor who says, here's 10% of my assets for gold, we are buying. So, I mean, I think the gold stocks are still very, very undervalued. And you know, the thing is, as the stock prices have moved up dramatically. But if the stock prices have moved up less than the increase in cash flow and the increase in the value of reserves, then they're not keeping pace.
Yeah.
And so if you look at a company, whether it's Agnico or whatever, I would say that Agnico today is better value than it was 2 years ago at half the price or less than half the price. And that's because the cost of mining, we're very fortunate right now, the cost of mining has hardly budged. And so when you've got the price of the product you sell go up, 2.5, 3 times, yet your costs of mining have hardly moved, then you have tremendous leverage on the price of gold. So if the price of gold doubles, your cash flow has gone up far more than twofold. And the value of your reserves, obviously this ounce of reserves has doubled, but when the price of gold doubles, you can bring more resource into reserves. So your reserves are growing. And so all these companies are much more valuable today than they were a year ago. And on various metrics, valuation metrics, they are cheaper today than they were 2 years ago. People who've been buying gold for the last 3 years have not been looking at the economic factors, and they've been price agnostic. That's very important. So I don't think price agnostic, meaning they'll buy at any price. The central banks are not looking at the daily chart to decide whether to buy or not. Tether, which, as you probably know, for the second or third quarter of the year, last year, bought more gold than any central bank.
Yeah.
Excuse me. And they're price agnostic. Obviously, they want to get a better price if they can. And so the traditional correlation between gold moving up equals higher risk equals more volatile stock market, I don't think is logical. Now, having said that, I certainly think that the U.S. stock market is primed to fall. And the reason it hasn't fallen is simply because there is so much automatic money coming into the U.S. stock market that's going into passive funds.
Yeah.
All that 401k money, over half of it is in the S&P funds, right? And that money, as long as people are employed every month, that money is going into the 401k and is going into the U.S. stock market. Again, I don't think the traditional economic criteria that people use to decide whether or not to buy gold, that's not why people are buying gold now. They're buying gold because they're afraid of what's happening in the world, the uncertainty, shall we say chaos, but the uncertainty in the world, and the fact that fiat currencies around the world, including the dollar, but fiat currencies are losing their purchasing power. And so people are buying the dollar, and it's nothing to do with inflation expectations, in my view. That may come, but it's not. The Central Bank of Uzbekistan doesn't say what's my forecast of U.S. inflation. That'll determine whether I buy gold or not, right? But people have been buying gold, and Tether doesn't say, inflation's going up, let's buy gold.
Yeah.
Inflation's going down, let's not buy gold. So the people buying gold are not concerned with the traditional economic criteria.
Once central bank buying eases, maybe that's when the market eases as well.
For gold, I think so. But as I say, there's other things. There's Tether buying now.
Right.
Now, Tether, Juan Santuri, the chief of global projects for Tether, who is in charge of this gold drive for Tether, he thinks that the gold stable coin will grow as rapidly in the next 5 years as the U.S. stable coin backed by treasuries grew in the last 5 years.
Yeah.
That's their goal, that's their target. Even if he's only halfway right, that means Tether is going to be buying significant amounts of gold quarter after quarter after quarter. So I don't think the sentiment, if you look at sentiment, I just don't think that this is not an overwhelmingly bullish sentiment among the broad investor mass. So oil, the narrative around oil is just completely wrong. But because it is so hated, because there's this narrative we're not going to be having any in 10 or 15 years' time, because the banks up until Trump came in would not lend to oil companies, because government pension funds and so on would not invest in oil companies, what did oil companies do? They did the rational thing and didn't invest in oil exploration. So oil has been incredibly underinvested. There's been underinvestment in oil and gas for the last 10, 15 years. And the thing about commodities we have to remember is the commodity cycles are not the same as economic cycles. Commodity cycles are tied to the investment cycle. Copper has been very underinvested for the last 15 years, which is why the copper price has moved as dramatically as it has. Oil and gas have been significantly underinvested for the last 15 years because of this narrative, which is wrong. And the narrative that there is, which is put out by the International Energy Authority, because the narrative that there's excess supply is not true.
You're talking about oil now.
I'm talking about oil. Sorry. Yes, thank you. I'm talking about oil. Over 100% of the growth in oil in the last decade, the growth in global oil, over 100% came from U.S. shale. U.S. shale has peaked. That's a fact. That's not speculation or, wild talk. Or you look at field after field after field. They peaked. Production has peaked, and they're on the way down. Used to be thought that the downward slopes in shale would be very, very sharp, and the tails would be very short relative to conventional fields. We don't know that yet, but we're going to find out. But regardless, they've peaked, and it's on the way down. So the big question is, where is the future growth in supply coming from? Venezuela's one. But we're going to have to go back to the Canadian oil sands, and Venezuela's one. But you look at a lot of the conventional fields, Cantrell, North Sea, they're a shadow of their former self. And now shale, which was for growth, is declining. And yet demand for oil just consistently goes up. 2%, 2.5% year after year after year. So, I think that's enough on that, perhaps, but I think oil is very undervalued. Right now, lithium is very undervalued. So there's a lot of commodities that are undervalued relative to gold. So we're certainly putting more money into other commodities.
Yes.
I'm also putting more money into overseas stock markets, just generally. I don't know if you wanted to talk about that or not. Maybe you
absolutely,
don't.
Yeah.
But you look at the U.S. market. The U.S. market, up until last year, the U.S. market outperformed the World ex-US, right, as a Morgan Stanley Capital International Index, World ex-US. So the US outperformed the non-US for the last 15 years.
Okay.
These cycles tend to be long. Before that, foreign markets outperformed the US by 8 years.
Yeah.
Last year, you saw the turn. The World ex-US, so foreign markets outperformed the US by almost 2-to-1 last year,
right.
Almost 2-to-1. And you don't get that shift for 1 year and then it shifts back. So I think we're going to see, for the next probably 5 or 6 years, we're going to see overseas markets outperform the US. By how much? Let me just give you an example. The overseas markets would have to go up 2.5 times from where they are today, 2.5 times, to get back to their last cycle low relative valuation. Their last cycle low. So the potential for global markets to move up relative to the US, I think is very, very strong. Let me just say, January the 1st, global markets had never been as cheap as they were relative to the US market. And to preserve value in the face of deteriorating purchasing power of all fiat currencies. And this is not new. This didn't happen last year with the new U.S. administration.
Right.
This has been going on for years. But I think it's fair to say, I don't think anyone would disagree that nothing that Trump has done has assuaged concerns. But this started years ago.
Well, do you think that maybe higher gold prices and higher bond yields, rather, they've been moving in the same direction, that relationship will persist?
I think probably long bonds, yeah, because look, nobody wants nobody wants long-term U.S. Treasury, U.S. bonds right now. That's why Yellen issued pretty much everything at the short end, and that's why Besant is doing the same thing. Because, yeah, it's one thing to take a 3-month or 6-month and get 4.5% on the 6-month. But are you really wanting to hold a U.S. Treasury for 30 years at the current yield? I would say no one's going to buy that as an investment.